Welcome back to The Explainer. So today we're jumping right into the third part of our 10-part series where we're basically uncovering the absolute biggest misconceptions Canadians have about life insurance and taxes. If you want a Canadian-controlled private corporation, you'll definitely want to stick around for this one, because what we've found here could literally cost your family hundreds of thousands of dollars.
We're kicking things off with a pretty massive wake-up call. You see, most business owners think corporate life insurance is basically a tax-free magic wand. But if you don't fully understand what tax professionals call the ACB trap, your family could face an absolutely massive, totally unexpected tax bill on the exact money you thought you were leaving them free and clear. It's a very, very expensive misunderstanding, and we're going to clear it all up right now.
Section 1. The Magic Wand Myth. You know, there's this huge gap between the standard sales pitch and, well, reality. The myth out there is that corporate-owned life insurance death benefits always flow completely 100% tax-free to a deceased business owner's family. I mean, we hear it all the time, right? The proceeds bypass corporate tax. And sure, while that sounds amazing, what often gets left out of the pitch are the notional ledger mechanics happening in the background. Because when you actually look closely at the rules, only the death benefit minus the policy's adjusted cost basis, or ACB, can actually be paid out tax-free.
Section 2. Unlocking the CDA.
Okay, so to really get how this works, we have to talk about the Capital Dividend Account, or CDA. Now, this is defined under subsection 89(1) of the Income Tax Act, which, yeah, try saying that 3 times fast. But the CDA isn't actually a real bank account that holds cash. It's more like an invisible, notional ledger that tracks the tax-free surpluses that build up in a private corporation. This specific account is the exact pathway that allows you to distribute money entirely tax-free to Canadian resident shareholders. And what's super interesting here is how a lot of industry materials just plainly boast about the CDA's purpose, really highlighting how it lets you declare tax-free dividends. But what almost always gets buried in the fine print is the strict mathematical formula that legally restricts exactly how much money can flow through this account when a life insurance policy actually pays out. Honestly, the easiest way to picture this is just by thinking of buckets. When the insurance company pays out the death benefit, your corporation acts as sort of a holding tank. The funds then pour out into 2 totally different buckets. One is the tax-free CDA bucket, and the other is the taxable surplus bucket. The really crucial thing to remember here is that the size of your tax-free bucket isn't automatically the full death benefit. It's strictly limited by the policy's tax cost. So anything that doesn't physically fit into that tax-free bucket, it just spills right over into the taxable one. Section 3. The ACB Tax Trap. So let's actually define ACB. The adjusted cost basis is essentially the tax cost of your policy. Think of it as a running tally. In general terms, the ACB is calculated as the cumulative cash premiums you've paid into the policy minus something called the net cost of pure insurance. And here is the real kicker. Your ACB is the specific amount that the government forcefully deducts from your tax-free CDA credit. Now, what exactly is that net cost of pure insurance, or NCPI for short? It's a government-prescribed measure of pure mortality costs that the insured deducts every single year. Basically, as you age, the statistical probability of mortality goes up, right? So the NCPI generally goes up too. And because the NCPI is deducted from your premiums, it slowly grinds your ACB down over time. Meaning, if you hold a policy well into your 80s or 90s, the ACB often grinds all the way down to 0. But if we're talking about the early or middle years of a policy, well, it's a completely different story. If we look directly at the CRA's rules under that subsection 89(1), the credit that gets added to your corporation when it receives a death benefit is explicitly reduced by the policy's ACB immediately before death. So if your policy's ACB hasn't naturally ground down to 0 before you pass away, that remaining value acts as a strict, totally unyielding ceiling. It severely limits your family's tax-free payout.
Section 4. Real-world corporate math.
Let's actually crunch the numbers together for a hypothetical company. We'll just call them ABC Inc. Say the corporation receives a cool $1 million death benefit, but at the exact time of the owner's passing, the policy's ACB was still sitting at $150,000. Following the CRA's formula, we have to take that $1 million, subtract the $150,000 ACB, and the corporation is left with a CDA credit of $850,000. That means $850,000 can absolutely be paid to the family tax-free. But what about the rest?
That remaining $150 grand? Yeah, that is the trap.
This number isn't just some minor rounding error or a tiny administrative fee. It represents hundreds of thousands of dollars just completely missing from your family's expected tax-free inheritance.
Now, just to be crystal clear, that $150,000 isn't like lost to the insurance company. Not at all. The corporation still received the full $1 million in cash. But because of these ACB rules, that $150,000 cannot go through the tax-free CDA bucket. It just spills over into the taxable surplus bucket. And if your surviving family wants to extract that remaining cash from the corporation, maybe to pay for living expenses or help settle the estate, they are going to have to pull it out as a fully taxable dividend. That triggers massive personal taxes that come directly out of their own pockets.
Section 5. The new G3 reality. And to make matters a bit worse, the Department of Finance has actually been tightening these rules over the decades, sort of categorizing policies into different generations. We had G1 policies prior to 1982, and then the G2 era lasted all the way until 2016. But any policy issued after January 1st, 2017, that falls under the much stricter new G3 policy rules.
So here's why this actually matters to your bottom line. G3 policies use these updated mortality tables, specifically the CIA 8692 tables. Because, statistically speaking, we are living longer, the assumed mortality is lower, which surprisingly means the annual NCPI deduction is also lower. And if we think back to our formula, right, if you are deducting less NCPI every single year, your ACB just stays much, much higher for a significantly longer period of time compared to those old G2 policies.
So, the bottom line here, if you're holding a G3 policy, which again is any policy bought since 2017, this ACB trap is vastly more dangerous to your estate plan. A higher ACB literally equals a lower CDA credit. If a tragedy occurs during those early or middle years of the policy, a really significant chunk of your death benefit could just end up trapped inside the corp as taxable surplus.
Section 6. Escaping the trap. Okay, so based on all this, what are the big takeaways? Well, first off, never just assume 100% is going to flow through the CDA. Always ask your advisor to show you the projected ACV year by year before you buy a policy. Second, you really need to proactively factor this trapped surplus into your actual estate plan. Like maybe your corporation just needs to retain that cash to cover other tax liabilities. And finally, you have to be incredibly careful with your structure. Trying to shift corporate ownership back to personal ownership later on is heavily restricted by post-2016 rules under subsection 148(7). Doing that wrong can trigger some pretty immediate and painful taxable gains.
So, I want to leave you with this thought today. Is your estate plan actually ready for the ACB trap, or is your family quietly staring down a massive hidden tax bill they aren't expecting? Definitely take a hard look at your corporate policies this week. Thank you so much for joining us for this explainer. If you found this breakdown valuable, please remember to hit that like button, share it with someone who needs it, and subscribe. Now remember, this is only part 3, so you absolutely want to stay tuned for the 4th explainer in our 10-part myth-busting series on Canadian life insurance and taxes. We will see you next time.